and welcome. This is our Is 2026 Your Exit Year? How to Prepare for a Successful Sale webinar. Today's speakers are Jerome Fusco, Managing Director of SAX Capital, Colin Baker, Partner of SAX Advisory Group, and Lisa Mella, Partner of SAX Advisory Group. And without further ado, I'm going to go ahead and allow Jerome to jump right in.
Thank you, Amani, and thank you everybody for taking some time today to join our webinar. We think this is a very extremely exciting topic as there's a constant amount of news about sales and the M&A in the landscape in the news, and what will that look like for 2026. As Amani mentioned, my name is Jerome Fusco. I lead SAX Capital Advisors, which focuses on helping privately held businesses think through their sale alternatives with raising capital, selling their business, and going to market, and other key critical items. So I thought it was very important before we went into really some of the preparation and other aspects to talk about the economic and M&A backdrop, the things that are very important to sustain a sale are a strong economy and key factors. So one of the big things when we first start talking about how we think of 2026 is there's a sentiment of cautious optimism right now. And the reason I'd say it is cautious from everybody's perspective in the market is there were a lot of excitement going into 2025. And then with the implementation of tariffs in April, there was a lot of hesitation, pause spent on investment, reduction in capex, and ultimately a slowdown in M&A in Q1 and Q2, which picked up later in the year. So people are optimistic that that hopefully we have a lot of those items with respect to regulatory items and tariffs under control. But as you can consistently see in the news, there is noise currently even around potential more tariffs to Europe. So we will continue to monitor that situation. Other key tailwinds or positive factors that we see driving the year are increasing adoption of AI and other tech-enabled services. So not just necessarily like all the buzzwords around AI, but the increased potential to be more efficient and to be able to reach more audiences with your technology. And then just general stock market performance, a continued solid performance of the equity markets is very critical to sustaining near-term positive growth. We also want to continue to sustain the end of year Q4 positive momentum that was seen in the M&A market. So we ended the year on a very positive note, and there's a lot of optimism that we'll continue to seek that. And what has been the case for the past kind of like 5+ years is private equity has been sitting on a lot more capital. A, because of a lot more fundraising, and B, because as people are cashing out their investments, they're waiting on strong opportunities, and that continues to be the case. There's plenty of what's quote unquote dry powder to do more deals. And then one thing we've been seeing a lot lately and hearing from a lot of investors is we know there's a lot of quality businesses that for one reason or another have not come to market yet. So those are things that people will continue to wait and see, a flight to quality. That's a key focus for investors. They think there's a lot of A+ assets that are sitting on the sidelines, and hopefully your business is considered one of them. So on the next slide, what do those items mean for privately held businesses, and how should you start thinking about a sale if this is the year? And I've identified 3 key focus areas for you to think about throughout the course of the next few, as you're considering this decision. One is leadership continuity. This is absolutely critical, not only if you're thinking to sell, but just in general of strong preparation for planning for the future of your business, even if you have zero interest in selling. And what do I mean by leadership continuity? What does that next layer of management look like? Gives your business further diversification, not only across individuals, but also allows you to cover more customers, potentially add more services, and just show a stronger breadth of services and bench. Investors are always looking for a deeper bench and saying, okay, if leader Joe Smith leaves, what does that mean for the business? Does somebody have all the key relationships? Diversifying that and strengthening with a strong operational bench is critical. Also identifying key growth areas and opportunities for your business and how you can market that and push that to investors. So I often use the example of Apple. People have done very well buying Apple stock, but you're buying Apple stock for brand, for recognition, but also for future growth opportunities. So investors aren't only buying because they invented the iPod, they're buying it because they think they can take advantage of new geographies, grow new products and services. And we sit with owners and they think about their and push them to think about their businesses in the same mode. You know, if you had a little bit more capital, where could you invest and help this grow? Where could you help? Where could you help do add more services? Can you add more people here? Are there any markets that you're not taking advantage of that we can be thoughtful about? And portraying this to investors is absolutely critical and will help push your value up. And these don't necessarily be things that you have to execute on in the next, 5 to 12 months. Instead, things that can be thoughtful that you can work on with the next investor. And then the last focus area that's very critical to what we're discussing today is the thought of strong and solid preparation. Diligence has become deeper and slower, and strong preparation will reduce stress done in this. But with all the things going on and greater transparency and communication, there's a lot more added focus on due diligence in a lot of different areas. So as we think about as we think about preparation, that is absolutely critical. So on the next slide, we really emphasize the key areas of focus for a successful transaction. And I highlighted on the right hand of the slide a recent survey which talks about market readiness. And it was surveyed between a number of investors and a lot of CEOs who are talking about their view on the market right now. And as you can see on the right hand side in 2026, there's a very strong willingness to sell on the top and a very strong willingness to buy. Both has been the highest point over the last 3 years. So this generally means there's a large market to transact, which is great news. So now that we feel there's a strong market to transact, let's discuss some of the key points for a successful transaction. We think engaging the right advisors is absolutely critical. So having a strong group of bankers and M&A advisors, along with the attorney and tax experts, will ensure a positive outcome. You also want those individuals to start speaking with yourselves on group calls sooner rather than later. So you're all rowing in the same direction, understand all of the complexities, and start to get on the same page, and ensure that everybody's responsibility is predefined and that you're thinking about things in the right manner and listening to all the best ideas in the room. Now, the next thing we discuss with owners is doing a strategic review. So this we go over some of your key positives. It's like a SWOT analysis, strengths and weaknesses and opportunities and threats. And we'll talk about different things that can help you push value up, things that can help be a detractor, and things that we should start to think about as opportunities and threats. This was pretty imminent last year when we were going over with a lot of our distributors and manufacturers about exposure to certain countries and how should we be thinking about them. And then that goes into our next bullet, which is assess the key risk areas. So we want you to think about potential vulnerabilities. Again, like, if you have a lot of exposure to China, and what kind of key mitigants do you have in your arsenal to try and lessen that risk? Now, there's a lot of things that might not be able to potentially prevent. So, if your company is doing $50 million of revenue and you have reliance on 2 or 3 suppliers, it might not be easy to pick up and move your operations or your supply chain right away. But are there other potential mitigants that you could put in place to lessen financial damage? Are there other channel partners that you could partner with to be helpful in your supply chain? These are things that we think through, and we like to have these answers ready before we go and speak with investors, just so we're thoughtful. And when they start asking these questions, we're very prepared and showing that we put in thought, and then they can work with us on a strategy to go as well. And then I say financial diligence for the last piece of the slide. This is the backbone and very critical to the M&A deal, as you can imagine. This is the first thing people look at. It helps drive valuation decisions. So I'd like to take this time to introduce Colin, who will go into this. he leads our transaction services group, and he'll go into this topic in more depth.
Yeah, thanks, Jerome. So I lead, as Jerome mentioned, I lead SAX's transaction advisory services team, where we specialize in buy side and sell side quality of earnings. For this specific webinar, it's mostly focused on the sell side, which, as Jerome mentioned, is a pretty key and integral part of the process. There's a lot of advantages to working with sell-side QV providers, which I'm going to lay out in bullet points here. But the first and almost the most important is it just increases credibility and buyer confidence. It shows any potential buyer, whether it's strategic or private equity, that you're serious about a transaction. Bringing in a third-party financial expert to scrub the numbers helps provide a clear financial and transparent story and demonstrates financial integrity. Um, it helps to identify any one-time or non-recurring expenses to normalize what we call adjusted EBITDA, which is eventually where it's honestly what they're going to end up using for the valuation. Depending on the industry, it could be revenue. Um, but it also attracts more buyers as well. The second point is it does maximize value and protects valuations as well, and ultimately reduces surprises. It helps give you, as the business owner, the chance to kind of control the narrative and protect the valuation that you're looking to get. Ultimately, being on both sides of it, you don't want the buy side due diligence team to find anything because when that happens, they try to retrade and reduce the valuation, which I'm sure Jerome can talk ad nauseum at that about some war stories. It also helps identify any potential risks or potential accounting issues for any what I'll call deal killers, right? I mean, the main ones could be your revenue recognition, if there's any issues, whether there's any inventory issues, how that's accounted for, or as Jerome had mentioned briefly, operational risks from customer vending concentrations, whether there's key man risks, does the owner have all, call it the secret sauce? And it also helps create the to-do list as well. It helps if we were to identify or whoever were to identify any potential issues, it gives you the ability to remediate it and go to market essentially. I won't say scot-free, but a buyer can't keep that in their back pocket to retrade or renegotiate purchase price if they were to find anything if it was already disclosed. Thirdly, that it gives you the stronger negotiating position. It allows, again, to control the narrative from your perspective, what you're looking for, especially from a net working capital perspective. The valuation is one thing. The quality of earnings is used to justify the valuation, but really it's a lot of consulting related net working capital or net debt related items that helps provide an advocate there throughout the process. Um, and most importantly, the next bullet, it helps accelerate the deal process. It can be a long, drawn out process, as Jerome had mentioned, but it does really help going through a dry run, or I'll call it a spring cleaning beforehand. That way, pretty much everything's available to a buy side team, having already gone through the process, and frankly prepares you for what it's going to be like, and reduces the time to close, which goes along with the fact that it will be smoother. There's less headaches, as much as that could be, right? There's going to be some headaches during the process. There's going to be some frustration, but I can tell you, it does help prevent deal fatigue and helps you get a deal done faster rather than taking too long. But with that being said, I'll turn it back to Jerome.
Thanks, Colin. I appreciate you going over that. There's clearly a lot to unpack, and we could spend 4 hours just going on all the analysis we do on the financial side. But clearly, very important. As you mentioned, we want to reduce headaches, and but there's a lot there. So we also want to be thorough and making sure that we're checking under every rock and making sure we're doing everything, and not getting caught with anything that we were surprised by. So on the right, on this slide, we want to discuss a little about keys to a successful process. So on the right-hand side of the slide, we highlight a bunch of the factors that private equity has said will drive deals this year, and all of them are very positive, I believe, for the sellers participate and business owners on this call. First of all, more attractive valuations. So that's very good. We want to get you as much money as you can for your business. So as valuations tick higher, that gives people another reason to sell. Improved in domestic economic conditions. we love to hear that. Even if you're not going to do a deal, if you never want to sell at all, an improving economy generally benefits nearly every business we work with. So we like to see that's a view from some solid private equity investors coming in, increase in AI companies, and increase in the scale. We think that's even more broad than that, just more tech-enabled services to help out people. The increase in sellers will also help as well. So taking all of these things into account, the critical drivers of M&A success, uh, there are a lot of things to think about here, but these are things that we speak frequently with our investors, our clients prior to going to market, that investors will think about, and then how they should think about different things. So number one, understand the buyer universe. This is important because depending on what you're looking to achieve in your transaction, you may be going out to a strategic investor, such as somebody who does what you do, just in a different area. Maybe they're not in the US, maybe they're in Europe looking to get into the US. Maybe private equity is the right investor where you want somebody purely financial, or maybe there's a hybrid of in between. There's a number of private equity companies who support very specific industries who might have a little bit more tribal knowledge than others, and that might be the right investor one. So sitting down with your M&A advisor and thoroughly going through all the potential buyers is absolutely critical. Striving for a premium or top end valuation is also something that everybody wants to achieve when we go into a process. Nobody ever says they want less, so I'm pretty confident everybody wants as much as possible. And what we sit down and spend a lot of time with our clients is going over the industry in which your business operates, and then generally where we observe multiples. And our goal is to get you at the high end of that range. Every industry generally has different multiples based on free cash flow perspectives and growth perspectives. So, as you can imagine, a widget manufacturer will be a little bit different than an AI company. And there's pros and cons to each of those, and understanding where within that valuation range you sit and what we're striving for at the top is very important. Um, Emphasize infrastructure and scalability. We speak a lot of times with clients who say, "Hey, like we could be a lot more profitable, but we have a good amount of people, so we can support more growth." And I think that's very important. You've built a real business here, so the fact that you have an actual infrastructure and you can support adding a couple more people and a lot more sales, whether it's from a distribution side or manufacturing capability, that's important to highlight. So maybe you're not as efficient as you could be with all of your expenses, and you're not squeezing every last penny out of your margin, but you have the ability to grow and support scale. We speak with investors who like to see that a lot. That way, they don't have to come in day one and add 15 different things and make wholesale changes. Having infrastructure and being able to scale is very, very key. We also emphasize people to keep an open mind on the buyer universe. And what I mean by that is you might have heard things from a third party or out there with not a lot of basis about this investor who did this, this, and this without really firsthand knowledge. And we ask to keep an open mind. Now, with that being said, if you have direct experience with somebody who didn't treat you poorly, well, we might not invite that investor under the hood. Or if they had a bad experience, we might do a little bit more diligence to ensure that you have comfort going out in front of that person. So, all things that we discuss. We also think it's important to protect critical intellectual capital. And this is not just uh, limited to service marks and trademarks and patents. This is broader. This could be the way you go to market. This could be your company's secret sauce. This could be key channel partners and relationships that you have, or anything else that you think is very important that somebody from the outside might not understand right away or might use to their advantage. So we generally try and preserve a lot of that information being shared until we have a lot of deal certainty, or we're pretty far down the road with one party and it's critical to their investment decision. So we want to be very mindful of that and spend a lot of time with our clients up front, understanding, hey, what are the 3 or 4 things that you want to absolutely hold back? Um, and then the last bullet point, which I emphasized a little bit on our prior slide, was that teamwork is absolutely key to a successful closing. You need to have your oars rowing in the right direction. And to talk about the absolute importance of estate planning is Lisa, who oversees our estate and trusts group.
Thanks so much, Jerome. As Jerome mentioned, I am a partner and leader in our trust and estates niche here at the firm. So constantly having conversations with clients about estate and gift planning. So where do I kind of come in? So when clients are thinking about a sale is on the horizon, they're going through a sale or even post-sale. So it's never too early to talk about estate planning and gift strategies during life. So we meet with clients, my team and I, and we have conversations about exactly where they are in the estate planning process. So I like to kind of divide it up into two stages. So there's stage one planning where clients don't have any sort of core documents. So we kind of discuss what those are and help clients to put those documents into place. What are core documents? A will, healthcare directive, power of attorney, maybe a revocable trust makes sense, guardianship paperwork if you have young children. If you have existing documents, we'll take a look at those. We'll confirm that everything that's outlined in those documents line up with the wishes that you have. Do updates need to be made? Are key players that are named in the documents, do they need to be modified and updated? These are kind of the conversations that we have. Um, we will then take it a step further and we'll outline your assets. We can help you with that. If you have something in place, like a personal financial statement, we'll take a look at that, review the titling. We'll assist with making sure that designated beneficiaries are in place for assets like retirement plans and life insurance. And then for clients that are, happy and content with their existing documents, no modifications need to be made, or maybe we're doing this concurrently, I like to then say stage two planning is more advanced planning. So we get into discussions about lifetime gifting strategies, setup of trust structures to achieve goals like asset protection, maybe estate tax savings. The exemptions are really high, 15 million now per person. But there still could be non-tax reasons or tax reasons to want to do some advanced planning. State income tax savings, so maybe exploring doing a trust in a non-taxing jurisdiction. And then we always kind of talk about maybe using exemption, lifetime gift exemption now when assets are lower in terms of value and they're expected to appreciate in value over time. So what I also like to talk with clients about is if you have no plan, like if you do nothing, the state laws of intestacy are going to dictate how you want your assets disposed of. So most people don't want that to be the case. And there could be unintended consequences with that. So certain states have an inheritance tax that can go, New Jersey has an inheritance tax that can be up to like 16, 18%. Some people are not aware of that. So we talk through that. As Jerome mentioned, we like to take a collaborative approach with other advisors to get the best result for our clients. So we typically team with financial advisors as well as an attorney. We don't draft, we don't draft documents here. So before I turn it back to Jerome, I want to give a quick client example. So Jerome's working with a client. I'm also working with a client. They have an LOI for sale of their business on the table. Client has existing documents. He shared them with me and my team. So we're going to review and outline those. This just happened actually last week. The client also had a personal financial statement. So we're going through that. We're going through the titling. What would happen if something were to happen to him? How would the assets get disposed of in accordance with his existing documents? And then he wants to talk about some advanced planning, that stage two planning that I mentioned about trust structures. He has one asset in particular that he wants to layer in an LLC and a trust so he can get some additional asset protection and freeze the value. Um, Conveniently, he's working with an attorney that we've already collaborated with in the past. So we're going to go ahead and collaborate with her as well. So that's my client example that I'm going to end with and turn it back to Jerome.
Thanks, Lisa. Appreciate it. Very, very helpful. As I alluded to earlier on, but I'll restate. We speak with a lot of business owners on a daily and monthly basis, and a lot of them are either never have any interest or selling, or years and years away. And we like to always say you should always have your house in order and be prepared, for a sale, even if it's never an interest, because it just shows, being a good steward of your business. If I were to take away one part of that aspect, it's please focus on having a solid estate plan, because as you can imagine, you never know when something's going to pop up, and that's one of those things that you can't retroactively do. So, that is a critical element to just and hopefully helping you sleep a little better at night. Um, so back on to some of the M&A items. One thing, we see a lot of webinars and go to a lot of conferences, and I thought I put in this slide about insights you might not have heard before, to maybe break up some of the repetitivity that you've seen in some webinars, but things that we think are absolutely critical to emphasize. So one thing I've probably gotten about 6 or 7 times over the past few years is the buyer's never as organized as they expect us to be. So I'm a seller, they're working with me, and we get a 400-page diligence list, and they wanted to see everything since the invention of the wheel from our company, and expect to be in perfect order and properly documented, to be able to be dissected within 20 minutes. So long story short, they're often surprised when they get under the hood of their buyer or investor, and it's like, oh well, by the diligence questions and the way they really grilled us, you would have thought they were a perfectly well-oiled machine. And I say, look, like I think it's always aspirational to try and have things as perfect as possible, but also keep in mind that if we don't have the answers to some of these questions, or they're not in the exact form, don't think that that's going to ever be a deal breaker, or necessarily being pencils down for everybody. And that's a good introduction into all deals have 9 lives, and maybe not nine, but generally at least three. The old adage is every deal dies 3 times. And it's a long and arduous process at times, and there's a lot of things that can be very positive, and a lot of things in a negotiation or diligence that might come up that give pause. I say this often to people at the beginning, like there's going to be some stressful times, and it's always important to take a step back and see the bigger picture, and just say like, okay, are we moving in the right direction for the right reasons? Is there something that gives us true pause, or is this just a negotiating ploy? And realistically, it'd be practical to meet somewhere in the middle. So those are all things that we think about. The third bullet, private equity can be empathetic. With more and more capital coming into the business, means that some of the old school, very pencil sharp private equity players have to be a little bit more empathetic and take the owner point of view. Now, in general, they're actually very nice people and can be very thoughtful, and have very strong approaches. But I will often get that comment like, "Oh, I'm surprised how nice they were, or about how thoughtful they were about our business." And keep that in mind. These are real people too, who are helping and looking at investing in your business, and want to be collaborative for the most part. The horror stories generally take the front page news, but the more and more that private equity gets involved in a lot of different industries, those are lessened and lessened. Um, Time kills all deals, but all deals take time. So I'm always very wary of people coming in and saying we can close this deal within 6 weeks. There's a lot to be done. There's a lot of diligence that needs to be done. Proper diligence is always key to make sure that we know the investor is doing all their work, going to be able to properly finance the deal. So we don't want things to drag out too long, but we also want to be very, very thoughtful in setting meaningful and appropriate timelines and expectations. This next bullet, the culprit of confidentiality breaches can sometimes be the last one you expect. And what I mean by that is sometimes it's the owner themselves, in our experience, that has unfortunately mistakenly left something on the printer, sent it to the wrong person in their email. So they might have meant to email a Jeremy instead of Jerome, and then all of a sudden they have to explain to their purchasing manager why they're talking to somebody about a deal for the company. So we spend a lot of time up front discussing how we protect confidentiality through code words, how we might ask you to use different emails, how we see who's monitoring your emails, and just different ways that we can look to limit this. And and obviously lessen the amount of people under the hood to protect confidentiality, because that is always critical to a deal. Uh, Calling referrals can be very eye-opening. We've had over the past few years a couple instances where investors have said, call some of the companies that we've done deals with, and they'll tell you how great we are. And unfortunately, that wasn't always the case. Some of them were non-controversial, like, hey, they're great people. They don't really add a lot of value, but they paid us a fair price. And then others, we've gotten to where I would not sell my company to them. So you just want to be very mindful and always call all referrals or anybody who they've done deals with in the past to see how it really is, and get you kind of a flavor for life under their investment. And last one on this page, once the deal is done, you'll miss your advisor. You're going to be speaking with myself, your attorneys, your tax team on a daily basis, and we build a good relationship and try and make it lighthearted and fun during the process. And we spend a lot of time together. And then once the deal closes, it does slow down a lot, and we still stay in touch, but we do believe you'll miss spending a lot of time with us once it's closed. So, with all those things, before we open it for questions, I'd like to leave you all with some concluding thoughts. So, we feel this year is poised to be a very strong year to bring your company to market. So, if it is something that you have been considering and want to discuss, we encourage you to kind of take next steps as we see a very positive economic backdrop. Again, cautiously optimistic, but still optimistic in general. Uh, if investors are going to want to see a transition plan, so we think that having that next layer of management identified and within the organization working towards the internal goals and taking strides to eventually lead the organization, diversify revenue streams, diversify individual risk, and have strong human capital. That's very, very important. So investors have been constantly thinking about that. Preparation is key for all phases of the M&A process. That's everything from working through your financials for hours upon end with Colin, all the way up to working with your tax advisor and making sure your legal documents are in good, healthy order. And then be prepared to learn a lot about your business and the market. A lot of people, when we close, will call me, and one of their first comments will be, I never learned so much about my business until actually going through this. And I wish I had done more of that up front. And that's what we try and do with some of the preparation. But in reality, unless you're selling your business and looking at a sizable check on the other side, you probably wouldn't spend 300-400 hours going through every little facet of your business in detail. But it is eye-opening. So I always think that's exciting, and it gives people more insights into it. And then when we use them as referrals, they'll tell our new clients about this. And as Lisa went into in detail, and we continue to emphasize, proper estate planning is critical. You don't want to be left blinded. You want to have a plan, and even your existing plan, you want to have reviewed and make sure it's up to date for all the changing regulatory items. And last but not least, it's never too early to start planning. So a sale might be 5, 10, 15, 20 years away, but we still want to talk to you about the market. So it's always easy to have a nice introductory call with myself and my team and go over just what we're seeing. Never any pressure on it. And we just like to speak with you and get your insights and see what's important to you and how at SAX we can be helpful. So with that, I'll thank you all again for taking time out of your busy day to join us, and turn it back over to Amani.
Thank you all. Wow, that was awesome. A lot of great information there. Just want to give the audience an opportunity to stay connected with all of our speakers. Feel free to screenshot this page, or we'll also have this presentation has been recorded, so we will be sending out the recording to you all. So if you don't have the screenshot, we'll get it over to you as well. But again, just another thank you to our wonderful speakers, Jerome, Colin, and Lisa. Now we will go ahead and open up the floor to some questions. We do have some questions that have already come in. So, question from Tim: what industries do you see having higher potential for acquisition in 2026 to 2027?
It's a good question. I think it. I think the easiest way to start is we definitely feel like the more people have the trade policy under control, there'll be a greater return to manufacturing and distribution deals getting done, because their supply chains are generally a little bit more reliant on overseas suppliers and partners versus service-based businesses. So if you over the past 18 months, we've seen a huge amount of M&A across the services industry. And when I say services, I mean everything from blue collar, which could be landscaping, plumbing, janitorial services, all the way up through high-end white collar services, which could be architecture, engineering, insurance brokerage, accounting, wealth management, and everything in between. And we've done a lot of work in services over that time. And while manufacturing and distribution still have gotten deals done, there's been a little bit more caution. So I would remain optimistic that M&A continues along all these areas, and hopefully picks back up on the manufacturing and distribution side too, especially as people start to think about expanding geographic capabilities, adding new product lines, and capitalizing on strong quality brands out there.
Thanks for that, Jerome. We've got a second question. What is the estimated cost and timeline to value one's own business?
So it's a good question. Generally, what we do in terms of timeline, just to give you an idea and value of the business, is we sit down, meet with somebody, go over the financials, and give you an idea of what we think it's worth. We don't put a dollar value on it when we give a presentation. We generally give a range based on a number of different factors that we continue to refine over time as we work together. But we can generally give you an idea on like what we think the value of your business would be and what the structure of that value would be. So not just cash up front, but how it'll look over time too. And there's no charge to that. It's not a formal valuation that our firm does for tax purposes. That's a separate discussion. But we can generally give you a range on what we think value would be, the timeline, and kind of structure of a deal. Within 2 to 3 weeks of meeting, and it wouldn't cost you anything.
Okay, perfect. And our last question. This one feels a little more intricate than the others, so bear with me. But the question is, does your group help plan DING or similar trusts, Delaware incomplete non-grantor trust, to help avoid state cap gains taxes in a sale? And if so, can you give a brief overview of the structure and timing? A
That's
doozy.
a question for me
That's a Lisa question.
specifically. So yes, we do actually. So this would be kind of how I spoke on the stage 2 planning, and I love client examples. So I just had a client recently who put a DING structure in place at the end of 2024 and is going to have a sales transaction this year in 2026. So we set up a trust. It's a non-grantor trust, so the trust is going to be the taxpayer, the one that's going to be responsible for any gain on the sale when the transaction occurs and there's a recognition event. It's going to avoid any state income tax. The clients, this is perfect for our clients that are situated in high state taxing jurisdictions. So our client, New Jersey resident, isn't going to be subject to the New Jersey tax on the gain on the sale, and then the trust is set up for his 3 daughters. So yeah, to answer the question, our group definitely can help plan that. We actually were involved from start to finish on that. We made the recommendation. We walked through all the options with the client. We engaged counsel. We worked closely with them on putting together the trust structure. We reviewed the structure. We provided comments, feedback. We ended up swapping out a trustee at one point because we saw some tax issues with that. And yeah, and we're hoping it's successful. And again, they're not going to have to bite the bullet of a New Jersey tax bill.
Okay, perfect. Thank you for that, Lisa. The questions are rolling in. We still have time on the clock, so I will keep asking them until we're a little further on. Okay. Our next question is, how important is having audited financials for a potential exit, and how far back the potential suitors asked to look back?
Yeah, I'll go first and then let Colin give his opinion too. But Most of the companies we sell don't have audited financials. And that's not to say if you have audited financials, that's not important. That definitely will hopefully lessen the diligence time because people are going to essentially do a forensic audit on your business. And if you already are doing an audit, a lot of those processes in place, they'll just follow and pressure test some of those. So, we've sold most of the clients that we've sold over the past 6 years do not have audited financials. It's always a plus if you do, but it's absolutely not. We've sold businesses with as little as a tax return, and as much as an audit and everything in between. And in terms of how far back do they go to look? Probably about like would they really probably base their value on 2 to 3 years of recent performance, though they might look back, since kind of depends on how old the business is and what sector. But if the business is 20 years old, they might look to see how it's done in certain recessions and whatnot. So it really depends. But if your business is only 5 years old, they can't go back much further than that. And really, the last 2 to 3 years is where they'll kind of focus on how they base their valuation decision. I'll let Colin give some more thought to
Yeah,
that question.
thanks, Jerome. I'll reiterate what Jerome said on the audit financials. We've done QOVs on companies that have had audited financials that haven't had that just had reviewed. A lot of the times it's really just based on whoever the financial institution you're lending from, if that's probably whatever they require. But typically, to Jerome's point, it helps if you were audited, it would make the diligence process a lot more efficient and smoother. Typically, the auditors look at things on an annual basis, whereas on a QOV, we'll look at it from a monthly basis. Then kind of segue into the next question. If you're looking at anything from a 3 years time frame, as an example, we'll look at everything on a monthly basis from January 23 to, I guess, December of 25 at this point, or what we call the trailing 12 months. And it's normally, they're mostly focused on the TTM period, we'll call it. And secondly, now that we're past COVID, knock on wood, they will probably, I've seen it where they've asked to see financials in 2021, 22, just to understand, to Jerome point, how did the business operate when there was a recession?
Yeah, and just one added point, if the question is like when they're doing their Q of E or forensic audit, they're probably just going to take 2 years worth. They're not going to do it for 5 or 6 years. It's timely, expensive, and has a lack of diminishing return. Now, if there's issues in your past 2 years and they need to go back further to make sure those issues aren't there, that could happen. But generally, like they will really spend their kind of like heavy diligence time in those last 2 years and might just high level look at the other years.
Awesome. Thank you both for that. We've got another question from Chris. How far ahead of sale should a company get their cash and or working capital at the correct level? I've seen clients holding more cash in the business than they need.
It's a good question. So it's really two-part, and I'll start with the former on the working capital point before I go into the cash. You really want to try and get your working capital as efficient as possible, as early on as possible, because generally people will do a 12-month look back on working capital and potentially even further depending on certain trends. So you really want to try and keep working capital as efficient as possible. With that being said, most transactions, whether they're in the lower middle market or even larger market, in the mega deal market, are structured as cash-free, debt-free, which means you keep all of your debt, so you pay off anything at close, similar to if you were selling your house, and you keep all your cash. So having excess cash in the business that you haven't taken out generally doesn't have a impact on the value of the business. Now, if you need some cash in there to add it, now if your working capital goes negative and you do need to draw on cash, that does come into account. But again, Colin, I'll let you add any more insights on
Yeah.
the working capital piece because
Yeah,
that's
to Jerome's point, it's most always on a cash-free, debt-free basis, so you'll keep the cash. From a net working capital standpoint, um, it's honestly the net working capital negotiations towards kind of the end of the deal are usually the most contentious. To your point, Jerome, understanding kind of the buyer wants to inherit the company, where they don't have to put in any additional capital to run operations. It's the whole purpose of kind of the net working capital. Um, so it is important to nail down what that looks like, because normally the buyer and the seller will agree what they call a net working capital peg, and they'll close on the deal. January 20th, 2026, but then they'll have a true up period, and anything above working capital can be a purchase price reduction. Anything below can be a purchase price additional purchase price, additional consideration, or it could be a reduction if you don't say meet that net working capital requirement at closing. My personal opinion is it should be no blood really. No one should be enriching themselves off of that, but. Again, that's part of Jerome's job to help manage that, or someone similar to Jerome, because it does get, believe it or not, I have actually had more contentious conversations and negotiations surrounding net working capital than adjusted EBITDA for sure.
They are definitely contentious, especially because an owner will see a lot of accounts receivable potentially in the business, or a lot of inventory, and say, "Well, I'm not getting paid for that." And that's why up front we emphasize very importantly that the multiple represents your business operating going forward. So it assumes that that business is coming with that working capital that could sustain operations, similar to if you bought a real estate a house to or a property to do in real estate. It assumes it comes with the infrastructure inside that allows you to continue to make that money. Working capital can kind of be thought of similar. And Colin made an astute point earlier that if it came with less working capital, the investor has to put more money in. So in theory, instead of paying $50, they're paying $52 if the shortfall was $2. So it does become a bit of a negotiation because of fluctuations and because of like how is this business properly run. So we do try and make it fair for both sides, and not and equitable.
Yeah, and to add on to that, Jerome, just one more point. A rule of thumb is the buyer wants the net working capital peg to be as high as possible, whereas the seller typically wants it to be as low as possible for any potential adjustments to purchase price. But realistically, it 95% of the time usually falls within an equitable or middle range.
Yeah, and some of the stuff we've done on recent deals is putting a band in. So like let's
Yep.
say working capital is $2 million. We say, okay, like let's do a $200,000 band above and below. So when we do the true up period, we're not fighting over every little expense and every little Amex thing, and that we can just move on and avoid contentious so the relationship can continue to start on a positive momentum and not get hung up on this, because it does get very contentious. So it's a good question, obviously.
Mhm.
Okay, awesome. We've got two more questions in queue. This next question, it seems like more of a confirmation of what you all just shared. But the question is, so a cash-rich business which has extra capital than needed, that's a negative when selling, and it's recommended to balance or reduce the capital to efficient utilization.
I don't think it's a good question. I don't think not necessarily a negative. It's really a non-factor. Think about it's just money that you haven't dividended out of the business. So whether you've taken a distribution every year for 20 years, or you've let all that cash sit and grow in a corporate kind of savings account, it really won't have a fundamental impact on the business, if I'm answering your question properly. With that being said, if you can reinvest some of that cash and make operations smoother, or there are other things you're doing to become more efficient with your working capital, and you feel better about not having as much cash in the business, and you can live off maybe a line of credit or whatnot, that's probably more helpful to you. But generally, on a like for like basis, having more cash or less cash doesn't impact your valuation metric, because you keep your cash at close. So if you took it for the last 20 years and you took $20 million out, or you didn't take a dime out and you have 20 million sit on your balance sheet, and you just keep it at close, your business value would be the same.
Yeah, to add on to that too, net working capital is something that, I mean, it's really meant to make sure something like that doesn't happen, right? If you're sitting on $10 million of cash and you're collecting your receivables, but then you're not paying down your AP, or you're not replenishing inventory, that's the whole kind of purpose of the net working capital peg, to ensure that the buyer kind of has enough capital to operate the company. So it's not necessarily a negative thing unless you're just playing games with cash collections.
Perfect. Well, thank you both for that answer. And what looks like to be our last question is from Anthony. Can you speak a bit to how you approach a deal based on strategic synergies versus typical financial multiples valuation, specifically how the seller can value their business given the challenge to create an objective valuation?
It's a good question. So Anthony pointed out that two kinds of buyers, a strategic buyer and a financial buyer. If you take the financial buyer first, the financial buyer is a private equity firm or a family office or somebody who's not involved in the business. And they'll look at the deal on a financial metric basis and say, how is this business going to grow? And what is the valuation today? Now, one thing to keep in mind, some of those financial sponsors will have a strategic angle but not necessarily be a strategic buyer. So that would be like BlackRock buying an accounting firm with no prior investment. Now on the strategic side, it's that would be, for example, an accounting firm purchasing another accounting firm where there are strategic synergies. So the question that you need to look at is what kind of things can somebody save? And usually you start with your operating expenses. So could there be, and this is not 15 years ago where it was, okay, we could cut 20 people. There's been quite a challenging labor market for talented people. So a lot of the deals we work on, most of the deals we work on, there are not going to be layoffs at closing. So we put those aside. Maybe there are some redundancies at times, but they still find a good home for people to work in. But let's put those aside. Potential insurance costs that could be saved, potential rent expense if people are moving into a different facility, potential on property and casualty insurance is another area. There could be supply chain procurement too. If you're buying from one supplier and you do $20 million a year and your acquirer is now it does $1 billion a year and they probably have better terms than you, both from a financing perspective and a discount perspective. So we do this analysis and we go over line by line by line, and your earnings to the financial buyer might be $10, but when the strategic buyers look at your earnings and all their savings they get, it could be 15. So we emphasize a lot in a lot of ways in our investor presentations, areas in which you can save money, especially if we're going out to strategics, so that if they're paying a 7 times multiple on $10, that's $70. But if they're paying that same multiple on 15, that's $105. So it's significantly higher, and we try and drive that home too. And obviously, they might not pay; they might want to share in some of the upside too. But it just shows why strategic buyers, all other things being equal, can generally pay a little bit more because they'll get some of those expense synergies. And if there's revenue synergies, that's a plus too. And there could be a lot of other qualitative things too, or non-financial things like taking a competitor out of the market or working with this person, or gives you geographic addition, so that becomes the build versus buy. Like if I want to open up an office in Maryland and Virginia, or I could buy one, what is the build versus buy decision there? What's the execution risk versus starting it from a greenfield versus buying something? So these are all things that we think about. But it's a good question because generally strategics do have an added level of synergies, which either means they can pay more, or the private equity firm has to get a little bit more creative in being competitive.
Wonderful. Well, thank you to our guests for all of the great questions. It looks like we were able to touch on all of the questions. If there is a question that wasn't answered, as mentioned previously, we will make sure that we follow up with you. And on behalf of the SAX team and our speakers, Jerome, Colin, and Lisa, we just want to thank you all for your time today.
Of course.
Thank you all for joining.
Yeah. Thanks, everyone.
Thanks, everyone.